This is not a full approval. We want to make that clear. But what exactly has changed, and how is this possibly opening the door now?
Yeah, that's right, Annabelle. It's not a full approval. It is a very big step towards approval, though. There are basically two departments in the SEC that need to sign off on a new exchange-traded fund. One basically decides whether it meets the requirements for the stock exchanges to actually list the product. So New York Stock Exchange, ARCA Exchange, the NASDAQ, and CBOE have all applied to list these products. So that's what was approved today. That is one piece of the approval process. The other is the documents known as the S1s. Those are basically the registration documents of the prospectus for the funds that lay out exactly how they're going to invest the assets, who's going to take custody of the underlying assets, and all manner of sort of nitty-gritty details like that. That approval comes from a different section of the SEC. They have not approved the S1s yet, so that is still to come. It's anyone's guess when and if that will happen. A lot of experts think a matter of weeks, perhaps. The approval of the other set of documents, though, to actually list these products on the exchanges does signal to many, though, that the other part of the SEC will eventually approve the prospectuses as well, which is really a pretty dramatic reversal in sentiment. As far as about a week ago, many of the ETF issuers we were talking to said, we don't think they're going to get approved because the SEC has not been very inquisitive and asking for changes to these applications or sort of testing some of the assumptions in the documents to basically give the issuers guidance on what they need to get approval. But it was a really sort of flurry of activity between the SEC and the ETF companies in this week so far that has led to these approvals tonight that we're talking about.
The other hot button topic is the removal of staking plans for these funds, right? Is this kind of seen as a short-term sort of downside or a net positive for the industry?
Well, it's a really interesting question. And for the industry, for the actual cryptocurrency industry, they are kind of happy that these funds will not be staking their tokens. And what does that mean? Well, Ethereum is a proof of stake blockchain. So what that means is if you're the equivalent of what you think of as a Bitcoin miner, they're called validators on Ethereum. What they do is they, quote unquote, stake some Ether to basically lock up on the blockchain to ensure that they sort of have skin in the game and that when they validate the transactions and help secure the blockchain, they're doing everything right. And if they don't do it right, then that staked Ether is taken away from them, or at least some of it. So the big question around staking is that these validators who do that earn rewards from the blockchain. So if you provide your Ether to be staked as part of this validation process, you earn a yield on it. It's roughly about 3 to 4%, I believe. So the SEC and the regulators, that raises the question, well, this looks a lot more like a security than, say, Bitcoin, where you do not earn a yield that way. So it's still not 100% clear what the SEC thinks of Ether as far as, is it a security, is it not a security? It is pretty clear that they do not want the ETF issuers who buy the Ether to actually stake the Ether.